Welcome back. In this brief video, I'm going to show you something very useful when you're thinking about your real estate investment, and especially when you're looking at the numbers, because many times when realtors try to sell you houses, they are looking at the aesthetic value and your personal values, but really they're not driven with the data science behind it. So I think it's really important that we start with the idea of real estate investment and real estate analysis, understanding the basic fundamentals. And there's a very easy concept to grasp, which is related with the cash return of investment that we're going to calculate. And the first thing that we can consider is what are the investments that you're doing, how much down payment we're giving, and what are the consequences as well of our rental income that we might get for that property. So all of these different variables are taken into account and calculated over a threshold that allows us to make a fair assumption if our investment is worthwhile considering in the longer run. So I've done here a scenario for a hypothetical investment property that should be interesting to note. So here it is. So the first kind of number of variables that we are going to consider are basically related with your income directly. So let's just create a field here called income, and that would be obviously the rental income that we're making. So let's put that the rental income that we are looking at in this area is $3,750 per month. And often, if you have a rental property, you might have, for example, a laundry machine or something that takes coins, and you can add additional things that service the property that you're renting out. If you have like a multiple unit place that you've bought, so things like, for instance, a laundry machine or additional, lawn maintenance services, things like that can be considered for your property. So, which would be additional sources of income. In this case, we do not have any of those, so we can jump into the total of our rental income property that we do, which is $3,750 a month. On the other note, what we have to consider is the expenses that we have. So a detailed overview of the expenses is super important for us to make a good strategy, right? So the second part would be the expenses related. And the expenses usually are things like, the taxes that you would have to pay in terms of the property tax, and as well the insurance that would cover your unit that you're renting out. So again, we are reminded that we are looking at the monthly basis. So the property tax usually is the insurance usually is a yearly amount given to you, but the property tax as well. So you just go with the $5,000. Say that you're paying $4,500 per year on property tax divided by 12. So it gives you a monthly estimate, and the insurance you're paying, say, $2,300 divided by 12. So here's your estimates. Let me just get a number that's like a little bit more around. It's 2,400 divided by 12. So with these values, you could have additional expenses that you would like to factor in. So for example, if you decide in your tenant agreement to add hydro, or if you're not looking at it from Canada, electricity, and or water, or any services that consider an expense for your property. In our case, for instance, in this example, we won't have any of those, so we can factor in the total as well. So let's sum this up here quickly, and then we get a total of expenses of $575. So another cost that you usually have to consider here, and just as an example, if you have multiple properties, you will probably have a property manager, and a property manager you will usually charge about 10% of our rental income. So we would factor that in, multiplied by 1, so 375, and that would give you the total that we have in terms of expense, right? But let's say that in this case we don't really have a property manager, and nothing of that sort, and we just total for 575. The third big concept to grasp is really to see our cash flow. And the cash flow is basically the difference between the income that we're generating over in our rental income and the expenses that we have on a monthly basis. So let's do that quickly. So we can actually just call it cash flow here. And to get the cash flow, we are just going to have the income here and the expenses right here. So the income that we have is 3,750, and the expenses that we have are 575, and that gives us the total of cash flow. So the income that we get minus the expenses. So we have a total cash flow of 3,170 a month, which is very, very decent. And we can now start to look at really the numbers, which are important to consider when you're doing a cash on cash return of investment analysis. So again, it gets much more complex because it can actually look at more the predictive and the impacts that you have on a longer run of your investment, say for example investment appreciations, etc., which are much more interesting to look. So, but this gives you an immediate static idea of your investment and how worth it is or not to actually follow suit with buying that property. So it gives you a first snapshot to further consider what analytics you might want to do. So to calculate the cash on cash return of investment, the first thing that you want to do is consider the down payment you did for that property. So say for instance that you've given a down payment of 20% for your property. So let's say that we bought this property for $775,000 and you're giving 20% down. So your down payment was $155,000, and then you have things like closing costs associated with that. So closing costs usually say $2,000, and then you have say renovation budget. In this case, let's say that we did a fair investment for $775,000 property that did really have not really any renovation costs. In fact, if you're looking at such a property at that value, again, we have to remind ourselves that for $775,000, you'd probably get a property that's in pretty decent shape. So renovation budget, 0 in this case, and let's say that we have other legal costs, whatever, that you might consider. And actually, let's put closing costs, consider lawyers as well. Again, you can discriminate all of these variables, and as you create a portfolio of different properties where you do the cash on cash return of investment, it actually becomes interesting to know the details of any of this individual rubrics. So in this instrument, we can actually now see the total investments. So I'm going to say total investment that we did is the sum of these values. Okay, so we have 158,000 investment, and based on that, we have, for one side, we've got our annual cash flow that we've already calculated, and let me highlight that value here. Okay, so we've got our annual cash flow, and we have the total investment. Okay, so with these two values, I can now make my calculations for the cash on cash return of investment. Cash on cash ROI. Okay, so how do I do that? I just take the annual cash flow that I calculated, which is basically given by 3,107. It's gonna put that here, 3,175, and the total investment that I did. So total investment, which is 158,000. Okay, so these are actually very interesting values to have, because if I divide this, so I'm going to divide this to make my cash on cash investment. So I've got to divide my annual cash flow divided by my total investment. So here it is. That's the amount that we have for our property. So our property is giving us a 2% off return in the cash of cash return of investment. Let me just put here as a percentage. And you ask yourself, well, it's not really, it's probably outperforming the current market in terms of stock market, etc., etc. But the big advantage is that if you're making a cash on cash return of investment over 2%, and if you consider on the other side your appreciation of your real estate. So for instance, imagine that you bought this property back in 2011. Well, actually, let's make it more recent. Let's do it. Then you bought it, say, 2018, and then you got 2019, 2020, and 2021, and you look at these values as they are, but then you decide to take that and actually say the buying price, $77,500, and you know that market has grown, say, by an average of, 8%. Let's say that this has been fairly constant over the years, although there's obviously some fluctuation to consider. No, so I'm adding some fluctuation in. You can already see that from your investment, we can, based on that, add the appreciation. So we have an appreciation of 183,000. If we take that value into consideration and subtract it to your investment, so here's the interesting thing in terms of looking at the future of it. So we subtract it, and basically that already in this 3 years made your total investment being zero. Of course, it's sort of a speculation. Then you can say that your return is incredibly much higher than it would be otherwise. Now, one of the things that I'd like to note as well is this scenario works very well if you're by any chance having down payment, but you're still considering what kind of mortgage you want to have. So one of the important components as well that's critically relevant for us to make the decision is to consider the expenses that you have on mortgage. And I usually like to have that at the end, because obviously the return of investment as it currently is a favorable one, but the mortgage conditions that you get for your investment can be a deal breaker and will reflect very differently the conditions of actually your expenses that you have. So let's add mortgage to your expenses as well now that we've done that. And the big advantage of actually adding it at the end is that you can assume that you've sort of negotiated with the bank different conditions, and now we're looking at what's happening in terms of your investment. So let's say that you've negotiated fairly reasonably well with the current low interest rates, and you're getting a property for $2,400. So now your total obviously changes, and this now reflects a true vision of actually your return of investment. But the mortgage of $2,400 and a property tax and insurance and all of that taken into account, calculating the annual cash flow over it, we're now able to actually have a clear idea of the total cost that we do. So again, the total investment was that. The annual cash flow is $775, which is a result of your income, $3,750, plus the amount of expenses you have. Cash and cash return on investment 5.89% is roughly marginally to 6%, which is, let's just round it up, 6%, which would be, by current standards of the market, a favorable condition to actually continue with that investment and keep it running as a potential rental property. What we'll do next is we'll look at some rental properties in Toronto so that we get an average idea of the average price that they're actually renting for. And based on this, we can have an idea of what is the cash on cash return of investment. So we'll do that with a condo, because one of the things that I've been asking myself is the condo market really still interesting to invest in Toronto, and what happened? So it's interesting to look at the dichotomy between downtown Toronto and in the outskirts of the city. And if you're not from Canada, you can actually try to look at other cities you're in. In the Canadian context, we're going to look at realtor.ca, and we'll start by going to the website, and in the website we can actually add on filters. And what I'm going to look at is the transaction type. So I'm interested in actually looking at rentals. So I'm just going to choose for rent and do a search. Okay, and we are looking at Toronto, so I'm just going to add Toronto, Ontario here to my study, and here I am. And there are like a load of many different properties. So what I'm just going to do is I'm just trying to find some of them to get an idea and give a medium kind of average size of the house, the property I want. So let's say that I'm thinking of investing in a 1-bedroom with 1 bathroom. And that's basically the investment profile. I could actually add more filters to it, and I'm going to leave it open because I just want to let the market currently speak as it is. So I'm just going to keep it like that, and I'll just choose a couple of them. And I'm really interested in looking at downtown Toronto. So I'm really just going to here in downtown Toronto core. Might be that it's not very different in terms of return of investment, but let's try to look at different areas, shall we? So let's look at Regent Park. And I'm just going to go to my Excel spreadsheet here and start building it up. So I'm going to call this Toronto cash on cash return of investment, and I'll sort of start building it up. So and I'll just take some of them. So Regent Park, I've got one which is $1,990 per month rental cost, $90.90, and that would be on Regent Park. So I'll add 2 Regent Park, and the other one would be $1,850 Regent Park 2. I don't need too many details because I'm just going to do an average estimate. So $1,850 for that one, and then I'm just going to go to another neighborhood. Let's go to the Discovery District. Doesn't have too many properties. $2,650 Discovery, and again should be 1 bedroom. Discovery District, and this is going for $2,650. Okay, and let's get some more property in the annex as well. So Bloor Annex over here. The annex 1,800. So let's add this annex 1,800, and let's add another one here which is available, 1,650 annex 1,650. And the more properties you have from a certain neighborhood, obviously the better and more clear the average is of the rental that you would have for 1 bedroom. So 1,850 annex 1,850, and let's say here 1,400 annex 1,400. And I'm currently not looking at the details of where it's located and all of these things and the infrastructure, amenities, and whatnot. That would be super important to analyze thoroughly, but I'm just interested in getting a picture about what's going on. Another neighborhood I'm going to look at is Little Portugal. So Little Portugal, Little Portugal got 775 and 1,600, 5 and 1,600. I'll call this Little Portugal 2, 1,600, right? And let's get one in right here, Queen's Quay. So let's do it here, Bathurst Quay, for instance. So 2,600, 2,350, 2,250. So Quay, 2,350, 2,600, and all right, should be fine. And any other neighborhood we want to look at. Okay, so let's take these ones. Now with these information, I can actually compare these properties to how much they actually would cost if I buy something there, right? So I'm just going to change my filter, and in my filter I'm just going to say for sale. There you go. So for sale, and I'm going to go to the same places. Regent Park, 2 properties for sale. Again, I'm looking at 1 bedrooms, so that's pretty consistent. $599,900, and I'm just going to use the same number for reference, and $499,000, so $500,000. And honestly, with the current market that we have, it's a very difficult market in Toronto. So this is not a price you probably buy it for. So let's add I would say roughly about 15% to that value. So equals to 15%. So that's probably what it's going to go for in a reality in the current market that we have. Okay, and then let's do that with the Discovery District as well. Discovery District, which would be Fashion District. And well, they don't have anything for sale, so I'm just going to go to the closest. Let's get a ballpark. All right, so let's get something here. 625,000. Okay, 625,000. And again, overhead. Yeah, overheads. No, actually, market speculation would be the price. Would be about that. And the annex. Let's get a couple of them in the annex, if we do have properties available, 1 bedrooms in the annex, which we don't. Let's go Bloor Annex and go surrounding here. So 625, 638, 625, 638, and Mervich Village 698. So 698. That's the listing price. So that's quite different than actually it's going to be sold for. Unfortunately, it depends on how you think about real estate, what investment property you're going to see it as. So we're going to do the same thing over here. So I'll multiply that 1.15 and actually, just drag it under. So we've got this price as well, and Little Portugal as well. If anything comes available in Little Portugal, we've got just one property as a reference. So 599,000, and it's just ballpark. So 599,000 again. Let's just drag it over here so we can get that. And Queen's Quay, we were looking at somewhere over here. Lots of property for rent as well, for sale as well. So let's look at here. Where were we? We're not Liberty Village, right? Can't remember where we were before. Anyways, let's look at, for instance, here. Let's look at West Queens West, Brocktown, Fashion District. Let's look around Fashion District. Why not? So 600,000. Shouldn't be much of a difference, anyways. Let's remove this one. Okay, can use it later on. So 600,000. And let's see, there was a property for 620,000. Right. So then we don't spend too much time with things that actually are not really relevant for that study. So the rental cost, we can now compute an average rental cost average. So rental cost average would be, for that would be, say, average and price unit would be average, would be that. So we got a price unit, and we can do the same thing over here, obviously. So we just gonna, I'm just gonna do the values here. So from Discovery District, we've got rental cost average, that, and unit would be this one. We're just looking just one, and we're looking at the annex as well. So average of the annex. Here we've got more properties that we took the time actually to look at, and here the average as well, average, and put it in. So we've got this one, and here it's going to be fairly consistent. So we're going to go here and average. And the more properties you have, obviously the more thorough your analysis becomes. Data will allow you to really reason the best cost opportunity that you might do. Okay, well, here we are, our averages. We've got our averages done. We've got our property location, and I'm just going to copy paste these cells and paste them as values right over here. Done. And we're going to remove this over here, just make it everything prettier, because we've already calculated pretty much what we wanted. We're going to delete these. We've got now the averages for a couple of different neighborhoods in town. Okay, just going to delete these as well. Here, Little Portugal. Okay, keep it here. And actually, you know what? I'll change that to, it wasn't actually the Queen's Quay. It was like Liberty Village, kind of. analysis. All right. So now that we've got this, we can actually start thinking about the same things that we thought earlier when we did our cash and cash return investment. So the first thing that we already want to know is the rental that we're going to have. So rental income, we have that already, and we will not add anything, but we'll probably add maintenance fees. So these are usually about $200, $300 for such a property. So we've got maintenance fees to set in. And what else do we have in terms of oh, actually, sorry, that's a cost. So we're not offering any services as it is. So it's actually only rental income. And then we actually look at the expenses, right? So the expenses would be maintenance fees, and about 200. Let's certainly keep it constant over the ones that we saw. I think probably Liberty Village would be a bit more expensive. The Annex, and let's keep it, let's say Little Portugal, a bit cheaper. I'm just guessing. So let's do it like that. Then we have to look at the other things, namely the property tax that we looked. So property tax would be about $2,800, $2,000 a year. So let's say, let's just look at one. So for instance, Little Portugal, we would buy this property, we would have property tax, annual taxes of $1,800. All right, so let's do an average of 2,000, and it won't really vary too much within the investments that we have here. So 1,800, let's say, then it's fairly constant as well. And then we have, based on that, we can decide whether we want to. Obviously, we'll have to have insurance as well, and let's say we have $150 for insurance. And here we've got now sort of our costs already calculated, almost calculated. So we can go, and we want to have a property manager. Okay, so for condos, I think it makes sense to actually have a property manager, which we pay 10% of commissions of rental costs. Whoops, that would be a lot. That's not what I wanted to do at all. So we've got our rental property, and then we have 10% of that. So that's what we're paying our property manager. Okay, so based on that, we can actually calculate the expenses. There we go. Sum them all up here. So that's the expenses that we actually have. Is that correct? Oh, sorry, I forgot to divide this by 12. Yeah, so obviously it's not going to be 1,800 per month, right? So we're looking at the month for now. So divide it by 12. And it was 150, so let's just share it here, 150. So this is our expenses that we have. And other than the expenses, as you might remember from earlier, we have now the possibility to calculate our cash flow. So let's do the cash flow really quickly here as well. So cash flow will be, let's change colors here. Cash flow will be our rental cost that we make minus the expenses that we have. So cash flow will be about 1228. Okay, not too interesting, but not too bad either. And now we can calculate the cash on cash return on investment as we did before. We are reminded by down payment. So we're going to give down payment 20% for all of these properties. Let's change the color here as well. So we're going to add down payment. I could put this here in a different color so we can have it all sort of standardized. So down payment 20%. So price unit plus the average that we calculated. Down payment, here it is. So we've got our down payment for the properties here, 20% of them if you're not using your own equity of your investment property income. But so you've got this down payment set up, and based on that down payment, we are already a step closer to what we calculated before. We can assume the closing costs. Let's add closing costs to it as well. Say $2,000. keep it constant as well. Obviously, there won't be too many variations in closing costs, but there's some variation that's going to impact on the down payment. So based on that, we can actually now calculate the annual cash flow. Let's have the annual cash flow for this properties and do a different color here. Let's see if I've got different colors that I can use. Okay, annual cash flow I can calculate very easily by using my cash flow, multiplying by 12. Okay, and do a different color here. Let's do it red. Why not? Okay, and now finally I can actually start thinking of doing by having my total investment that I've already calculated, which is here. Oh, I haven't had it. I haven't added the total investment, so that's important. Total investment, which is here, just another color. Running out of colors here, right? So I want to repeat myself here. Let's use, I don't know, just dark gray. Total investment would be the down payment plus the closing costs that I have. So I've got my annual cash flow, and to that I can actually look at something that I sort of forgot, and it's really important to add it as well, obviously, which is part of your expenses, which is the mortgage you pay every month, right? So I suppose that for a property of the value of $718,000 with a down payment of $200,000, was that more or less the average investment that we had? If your down payment of $150,000, you would have probably a mortgage of $550. I would say you could probably get a deal for $2,800, average ballpark. And as the prices are pretty similar, we can actually consider that in our mortgage cost as well. So let's add that to our thing. So here, cash flow, the down payment, closing cost, total investment. So our expenses would be this plus the mortgage. So I like to keep the mortgage as a separate component. Exactly, if I'm negotiating with the bank, I can see if it's actually a good deal or not. So the expenses are here. Okay, so, well, that shows you pretty much what is the current state of Toronto as a market for investment. So if you look at the numbers and you're looking at the cash on cash return of investment, you will see that the cash on cash return of investment is actually pretty darn bad in terms of return of investment. However, it's important to really note and consider what I've mentioned and what I'm mentioning about the appreciation value. So while the cash on cash return on investment gives us sort of a picture of what's going on, it is a static picture that really doesn't show the impact of the full enhancement of real estate investment. However, it gives you sort of an idea. And if you had to take any investments with curbing the loss of increment of prices over a given period of time, in this case scenario, it would be likely that Liberty Village and the Discovery District would be the best investments you could possibly bet. But still, you would have to hold, and you wouldn't be on a positive cash flow in any sense of the word, considering that you had maintenance costs, property tax, insurance, property manager helping you out, mortgage, etc., etc. You could sort of diminish the costs a little bit with letting go property manager, and then Discovery District would give you likely a little bit of a better scenario, but still not a scenario that I would consider an ideal setting for any real estate investment. Your annual cash flow would be driving negative over the year, which would probably be, would be positive again, given the increase of 6 to 8% average that we've had over the couple of decades in Ontario, in Southern Ontario, and Toronto much more than that. But this is sort of the average idea on how you would actually calculate the direct return of investment for a property in a cash-on-cash basis. Realtor.ca, this would be the neighborhoods you could start browsing around where interesting opportunities would be. So if I would be, for instance, looking at Discovery District, actually let me look at Liberty Village. Liberty Village, because there was, I think, more properties for sale around Liberty Village. So I'm just going to go for a sale, and I'm just going to say Liberty Village. And just, let's see here what I've got. So let's put here Liberty Village, Toronto. I have not tried to search it directly here. Oh, perfect, just neighborhood. So here I am, and I'm at Liberty Village, and actually look at the properties I have. The big advantage of actually looking at those listings in detail is now that you can actually look at the location, and the location can give you additional information. So as I start working on a data-rich environment and try to understand what's going on in the neighborhood and the surrounding, then I can start making really interesting decisions towards my investment. All right, good. Thanks for watching.